This is Peter Schiff again for the SchiffGold Friday market wrap. And what a week we had in the precious metals markets. There was a lot of volatility. We had the FOMC meeting and decision on Wednesday. We had a lot of action in the market today with a quadruple witching day with expirations of futures and options and all kinds of stuff like that, adding to some of the volatility. But all of it basically very bullish for gold to the upside. Gold finished the week up another 1.1%, not at a new record high, but just barely. I mean, we closed in gold right below 36.90, maybe 36.85. We touched 3,700 a couple of times over the course of the week, but we weren't able to get above it. I have a feeling we'll gap above it on Monday and maybe never look back. Silver was even stronger, up 1.8% on the week, but all of that gain today, because today's move in silver was 2.8%. So meaning silver was actually down 1% on the week going into today, and it closed up 1.8% because of a 2.8% move. Silver actually closed just above $43 an ounce. So we hadn't even been above 43 in 14 years, and now we closed above it. Year to date, just to put these gains in perspective too, gold is now up 40% this year alone in 2025. Silver is up 48%. These are incredible returns for precious metals, especially given that last year was also a very good year. But the only thing that's outperforming gold and silver are the gold and silver mining stocks. Today alone, both the GDX and the GDXJ jumped 5%. 5%. We didn't even have really a 1% gain in the price of gold. Or almost, I guess it was about 1% because it was $40, so a little over 1%, but 5%. So we had 5 times the move in gold stocks today as we had in gold. And the GDX closed at an all-time record high, never been this high. And the GDXJ is the highest it's been in 13, 14 years, something like that. On the week, the GDX was up 3.75%. And the GDXJ was up 2.2. The star of the day was Barrick Gold, which was up 10% in one day. That's rare for a company that big to be up 10%. Normally, you might see some smaller companies, although all the gold mining companies are small when you compare them to like the tech companies. But in the mining universe, Barrick is, I think, the second biggest, following Newmont, which was still up almost 5% on its own today, so not too shabby there. But these are all big moves. Year to date, the GDX is now up 113%, and the GDXJ is up 115%. Right, so these stocks are doing better than tech stocks. Newmont is the best performing stock in the S&P 500, but you would not know about that if you listen to the mainstream financial media. In fact, there was very little, if any, talk at all today in the mainstream financial media about gold stocks hitting, new all-time record highs. Nothing. They did focus on the S&P hitting a new record high. Sure, the S&P made a record high. Year to date, the S&P 500 is up 13.3%. 13.3%. Gold stocks are up 10 times as much. 10 times as much. So what's the big deal? And in fact, if the S&P is up 13%, but gold is up 40%, what does that tell you? That means in real terms, the S&P is down 27%. This is a major bear market in stocks if you price them in real money. But nobody's pricing them in real money. They're pricing them in funny money. And so you're getting an inaccurate perspective. Now, in other markets that were significant on the week, the dollar was actually only up slightly on the week. I think that's going to reverse, but it's still very weak, the dollar index. What was also up were bond yields. Again, I was forecasting that when the Fed started to cut again, long-term rates would rise, and that's what's happening. The yield on the 10-year finished the week at 4.13. On Tuesday, the day before the rate cut, it was 4.02. So the Fed cut by 25 basis points, and the long end has already gained about half of that. It'll probably gain the other half next week. The yield on the 30-year is 4.74. Now, I want to talk about some of the significant things from the week. The first one, of course, is the rate cut. I don't want to spend any time on this market wrap on the rate cut because on Wednesday, after the stock market closed, I recorded a Peter Schiff podcast, and I spent almost an hour discussing not only the rate cut, but the incredible admissions that the mainstream media didn't even cover from the press conference. It is a must watch. You got to watch it. So after you finish watching this, if you haven't already done so, go to my main YouTube channel, which has just under 600,000 subscribers. Subscribe to that and make sure and watch the entire video. It's almost an hour. And that's all on the rate cuts. And by the way, if you're watching this video on the SchiffGold YouTube channel, make sure and subscribe. We still barely have any subscribers. We get 2 to 3 times the number of people watching these videos as subscribe to the channel. So if you're watching the video, make sure and subscribe to the channel. So I'm going to skip the rate cut stuff. It is bullish for gold, and the Fed indicated that we're going to get at least 2 more rate cuts between now and the end of the year. So bullish, bullish, bullish. And so gold's got no place to go but up. Silver's got no place to go but up. But let me get to these 3 other very significant, news items of the week. One is I watched an interview with Stephen Moran this morning on CNBC. Now, Stephen Moran was the head of Trump's economic advisors, who is now serving a stint as an FOMC member. So, he's wearing 2 hats, although technically one hat, he's got checked. He's going to go pick it up. So it's obviously a big compromise of Fed independence to have a member of the Trump administration infiltrating the FOMC. But 2 startling comments that he made. One was he said that rates need to be much lower because he says the Fed is way above neutral. And not only is he wrong, not only are we not way above neutral, we're below neutral. We're too loose. The Fed should have hiked rates, not cut them. That's what the market is telling you. That's what the long end of the bond market is telling you. That's what the gold market is telling you. Nobody wants to listen to those market signals. Look at the money supply. Look at what's happening with consumer prices, right? We have high inflation, well north of 2% and headed higher. But I think an even bigger admission that should be even scarier if you're holding U.S. dollars and not gold is that Moran said that in answer to a question about the dollar, he said that one of the Fed's mandates is not a strong dollar or to worry about the exchange rate of the dollar. He says there's nothing in the Federal Reserve Act that mentions the dollar and that it's not up to the Fed. He said that the policy regarding the dollar, that lies with the president, right? Not the Fed, which should be very scary because if the Fed doesn't care about the value of the dollar, how is it going to deliver on its primary mandate of price stability? Because price stability relies on the stability of the dollar, because prices are a function of the value of the dollar. If the dollar is losing value, you need more dollars to buy stuff. So in a way, when the Fed is mandated to maintain price stability, it is also being mandated to maintain the purchasing power of the U.S. dollar. So to say that the dollar is not a part of the Fed's mandate either means you don't understand what the Fed's mandate is, or you're just lying. And so either, it's one or the other, but there's no, third option. So he's on the Fed, and Trump is going to appoint a new Fed chairman that is going to share that perspective. In fact, one of the president's closest confidants, or was at one time, Steve Bannon, he came out this week in favor of the president nominating Scott Bessent to be Fed chairman while he is still Secretary of the Treasury. In other words, Scott Bannon thinks that the chairman of the Federal Reserve and the Secretary of the Treasury should be the same person. One guy wearing both hats, or gal, depending on who's there. That is a horrible idea. I mean, often those two work together, but they shouldn't. There should be like a Chinese wall there. In fact, the Secretary of the Treasury, of the chairman of the Fed, needs to push back against reckless monetary deficits and fiscal policy. They shouldn't be working together, and certainly they shouldn't be the same person. But that's what they're advocating. So this is a real collapse of the perception of Fed independence. Even if the Fed wasn't independent, there was a general belief that it was, and now that's falling apart because they're pulling back the curtain and they're showing everybody that there really is no Fed independence. So I think the dollar is going to tank, but more significantly, gold is going to rally and rally big. And one of the reasons for that is Morgan Stanley just the other day, I think it was either Wednesday, maybe Thursday, but Wednesday, they came out and they officially adjusted the 60-40 portfolio. Now, the 60-40 portfolio is kind of like a mantra on Wall Street. It's how everybody should allocate their investments between stocks and bonds. And the benchmark is 60% stocks and then 40% bonds. And the only time they tweak it is as you get a lot older and you're retired, they will reduce the stock portion and increase the bond portion. But the standard cookie cutter model is put 60% of your portfolio in stocks and put 40% in bonds. Well, Morgan Stanley came out and said, we think that needs to be changed to a 60-20-20 portfolio. Still 60% stocks. They are reducing the bond allocation. They're cutting it in half. And they are replacing the half that they cut out with gold. So now you have a major U.S. investment bank telling its clients that now have 40% of their portfolio in bonds, that they need to sell half of their bonds and buy gold, right? Because the only way you can go from 40% bonds to 20% bonds is to sell half of your bonds. So in effect, what Morgan Stanley just did is they put out a sell recommendation on U.S. Treasuries, because U.S. Treasuries represent a pretty big part of that 40% that is allocated to bonds. Now, this couldn't come at a worse time for the Treasury, because the U.S. Treasury now has to sell a record amount of bonds, right? We have unprecedented deficits that were just exacerbated by the big, beautiful bill. Yet investors, if they follow the advice of Morgan Stanley, and if more major brokerage firms and investment banks follow their lead, because Morgan Stanley said that you need to do this as an inflation hedge, right? It's clear that inflation is going to be much higher than 2%. It's been above 2% for the last 5 years. The Fed doesn't even forecast it to get down to 2% for another 2. That's 7. And of course, that forecast is all BS. And I went over that in my other podcast. So I don't want to kind of steal that thunder. You got to watch it, because it's a startling observation that I made about a startling admission that nobody else is covering. But given that inflation has been so high for so long and likely to go higher now in light of the Fed's decision to cut rates, Morgan Stanley is saying you need an inflation hedge. You need to hedge your bonds. You can't have 40% bonds. You can only have 20% bonds. Now, I don't want any percent of my money in bonds, and so I'm already in gold and silver and gold and silver mining stocks. But most of Morgan Stanley's customers don't own any gold. And now they've been told for the first time to have 20% of their portfolio in gold. That's a lot of gold when you have zero. So Morgan Stanley clients and maybe other clients who are going to maybe get similar advice as the weeks and months go by, they have to sell all their bonds or half their bonds and buy a bunch of gold. So what does that mean? Well, first, for bonds, it means lower bond prices and higher interest rates, which also means higher mortgage rates, the opposite of what Trump is trying to achieve by pressuring the Fed to cut rates. So what does that mean? That means quantitative easing is coming next, right? Because that's the only way that they're going to get, at least in the short run, long-term rates to go down and mortgage rates to go down. But if they do that, they just create even more inflation and create additional incentives to sell bonds. And maybe it'll be a 60-10-30 portfolio, 10% bonds, 30% gold. And eventually, maybe it'll just be 60-40, 60 stocks, 40 gold with no gold. In fact, I was listening to an interview with Jeff Gundlach on CNBC, and he recommended that investors have 25% of their portfolio in gold, their whole portfolio, not just the 60-40, but 25% in gold. And the people were shocked, and they were asking other guests about it who were like, I don't have any gold, right? Well, they're late to the party. People are going to be buying a lot more gold. And so this is going to push the gold price way up, obviously, if all these people that don't own any gold are going to now be putting 20% of their portfolio in gold. But getting back to what this means for the U.S. Treasury, how is the U.S. government going to finance these deficits? Because foreign central banks are no longer buying treasuries. They're selling them. They're buying gold. The Social Security Trust Fund doesn't buy treasuries anymore. It has to sell them to cover its shortfall. And now individual investors aren't going to buy treasuries because if they have 40% and they have to go down to 20%, they're not buying anymore. They have to sell what they got. And the Federal Reserve is technically still selling treasuries because they're still doing quantitative tightening. They're doing it in a very small amount, but they're still doing it. So right now, the Fed isn't buying. So who's going to buy? Maybe they're going to pressure the banks to buy more treasuries. Well, then they're going to have to make fewer loans. It's going to crowd out the private sector. Now, maybe they're hoping that the stable coins are going to pick up the slack, but they're not. This is all a bunch of BS. There isn't all this demand for stable coins. That's just a bunch of hype so that the president's friends can make money selling all this crap and selling stock in companies that are creating all these stable coins that nobody really wants. I mean, why would you want to hold your dollars in a stable coin and earn no interest, right? At least if you hold your dollars in a money market, you earn the interest. If you sell the money market and buy a stable coin, now the stable coin issuer keeps your interest and you get nothing. But to the extent that stable coins buy treasuries, it's because mutual money market funds aren't buying them because people are going to take their money out of a money market and use it to buy the stable coins. And by the way, Bitcoin was down 1.5% today. Bitcoin is now down, I think, about 16% from its all-time record high over a month ago. In nominal terms, or priced in gold, down 16%. I forget what it is in priced in dollars. The high was 125, and now it's about 115. But we're down 16% in gold. More significantly, Bitcoin is down 15% priced in gold from its high 4 years ago. How do the Bitcoin holders explain that? You know, that Bitcoin is 15% lower than it was 4 years ago if you price it in real gold. So if Bitcoin is supposed to be, digital gold, gold on steroids, gold 2.0, why is it underperforming gold by a pretty wide margin over a long period of time, despite unprecedented hype to get people into gold? And in fact, I think that what's going to be happening in the weeks ahead is it's not just going to be people rotating out of treasuries into gold, but they're going to be moving out of Bitcoin into gold. I think a lot of people who have ETFs, Bitcoin ETFs, they're going to be moving into gold ETFs And they may even be moving into gold mining ETFs like the GDX and the GDXJ that are doing much, much better than Bitcoin, delivering much greater returns, and they pay dividends. And they have a lot more upside potential than Bitcoin with a lot less downside risk. And by the way, it is very significant that gold mining stocks are now leading gold. It's also significant that silver is leading gold. These were the ingredients that were missing from the gold bull market, right? All we had was gold going up, but not confirmation from an outperformance in gold mining stocks and not outperformance from silver. And now those were two of the reasons that there was a lot of skepticism of the gold market rally. Well, it's not being confirmed by silver. It's not being confirmed by the mining stocks, so it's probably not real. Well, those arguments are gone. I think you're going to see some major Wall Street money, institutional money, investor money, finally moving into gold when it's almost 3,700. But they're just getting started. And even if you look at these gold stocks, yes, the GDX just made a new record high, but it's barely above its record high from 2011, even though gold is almost double the high from 2011. And for the GDXJ, it still needs to rise by over 50% just to equal its 2011 high. Forget about beating it, just to equal it. So a lot of money is going to be coming in. So again, just like I've been saying, every time I've done one of these Friday market wraps, do not wait for Monday to buy your gold. As soon as you finish watching this, it's only about 20 minutes, right? And in fact, as soon as you're done, and obviously, maybe I should have said this at the beginning so people could have paused it, gone and bought some gold and come back. I waited too long. But now that it's almost over, when you're done watching, after you've subscribed to the YouTube channel and given this video a thumbs up, liked it, and put a positive comment down below, right? After you've done all that stuff, which won't take long, go to SchiffGold and buy some gold and silver. Now, you don't have to wait. They're open 24/7. You can fill up your shopping cart. You can give us a call. Do not wait for Monday. There could be a big gap up on Monday morning. So just buy it while nobody is paying attention. And then after you finish buying your gold and silver, then immediately go and watch my full 1-hour podcast on my main Peter Schiff YouTube channel to hear everything I had to say about the Fed. Because then after you finish watching that, you're going to want to go back to the SchiffGold website and buy even more. But don't wait, right? Don't waste that hour. Make sure you at least get some now before buying more later. And again, if you're aggressive, go to Euro Pacific Asset Management, Europac.com, and learn about my mutual funds, and in particular, the gold fund EPGIX. As much as I love gold and I love silver, I still love these mining stocks. They're not dirt cheap like they were back in April when I told all my SchiffGold customers not to buy gold because they should buy the mining stocks instead because they were so cheap. That report came out in April. Pretty much all the gains have happened since then because the first quarter was pretty quiet because a lot of people were dumping their gold stocks because they thought Trump was going to be bearish for gold stocks because they thought he was going to be great for the economy. And I was warning people that the opposite would happen. So I still like these gold stocks. Yes, they're not as dirt cheap as they were earlier in the year, but they're still cheap. And there's still a lot of upside potential, but you want to buy both. You want to buy physical gold through SchiffGold, and then make sure you have a position in these mining stocks. Talk to the representatives at Euro Pacific Asset Management about our separately managed accounts that specialize in gold stocks, and my mutual fund, which you could buy no load at any discount broker, the Euro Pacific Gold Fund, EPGIX. Bye for now and have a great weekend.